Imagine if you could look at a stock chart and instantly understand what buyers and sellers are thinking, who is winning the battle, and where the price is most likely to go next. That's exactly what candlestick patterns help you do. Candlesticks are not just random shapes on a chart. They are a visual story of market psychology, showing fear, greed, hesitation, and confidence in real time. Every single candlestick represents a fight between buyers and sellers within a specific time period, whether that's 1 minute, 1 hour, or 1 day. And when these candlesticks form certain patterns, they give us powerful clues about potential trend reversals, continuations, and momentum shifts. Traders around the world, from beginners to professionals, use candlestick patterns because they are simple, visual, and extremely effective when used correctly. To understand candlestick patterns, you first need to understand how a single candlestick works. Each candlestick has 4 main parts: open, close, high, and low. The body of the candle shows the range between the opening price and the closing price. If the candle is green or bullish, it means the price closed higher than it opened, showing buyers were in control. If the candle is red or bearish, it means the price closed lower than it opened, showing sellers were stronger. The thin lines above and below the body are called wicks or shadows, and they show how far the price moved during that time period before coming back. Long wicks indicate strong rejection of higher or lower prices, while short wicks show more decisive control by either buyers or sellers. Now here's where it gets interesting. One candle alone gives some information, but real power comes when multiple candles form a pattern. Candlestick patterns are basically repeated behaviors of the market that happen again and again because human psychology doesn't change. Fear and greed always exist, so these patterns keep appearing. Some patterns signal that a trend might reverse, meaning the market could change direction. Other patterns signal continuation, meaning the trend is likely to keep going in the same direction. The key idea is that candlestick patterns do not predict the future with 100% certainty, but they increase the probability of making better trading decisions. One of the most important concepts in candlestick analysis is context. A pattern is never powerful on its own unless you look at where it appears on the chart. For example, a bullish pattern at the bottom of a downtrend is much more meaningful than the same pattern in the middle of a random range. Support and resistance levels, trend direction, and volume all play a huge role in confirming candlestick patterns. Think of candlesticks as signals, not guarantees. They're like traffic signs on the road. A sign that says curve ahead doesn't force the road to curve, but it warns you to be prepared. Let's talk about the psychology behind candlesticks. When a long bullish candle appears, it means buyers were aggressive and confident, pushing the price up with strong momentum. When a long bearish candle appears, it shows panic or strong selling pressure. When small candles appear, it shows indecision, meaning neither side is confident enough to take control. Patterns form because traders react emotionally to price movements. For example, after a strong uptrend, buyers may start taking profits, while sellers see the price as too expensive and start selling. This clash creates specific candle shapes that repeat across all markets, whether it's stocks, crypto, Forex, or commodities. Another crucial thing to understand is that candlestick patterns work on all time frames, but their reliability changes. On higher time frames, like daily or weekly charts, patterns are more reliable because they include more data and less noise. On lower time frames, like 1 minute or 5 minute charts, patterns appear more frequently but can give false signals due to random price movements. That's why professional traders usually combine candlestick patterns with other tools like trend lines, moving averages, RSI, or volume to filter out bad trades and improve accuracy. In simple words, candlestick patterns are a visual language of the market. They tell you who is in control, who is losing strength, and when momentum is shifting. Once you learn this language, you stop guessing and start reading the chart like a story. You begin to see when the market is confident, when it is confused, and when a big move might be coming. This is why candlestick patterns are one of the first and most important skills every trader should learn, because they transform raw price data into meaningful information that can help you trade smarter, not harder.
Now, let's dive into some of the most important single candlestick patterns, because these are the building blocks of everything else. Single candle patterns are powerful because they form quickly and often appear at key turning points in the market. One of the most famous is the doji. A doji forms when the opening price and closing price are almost the same, creating a very small body with wicks on both sides. This candle represents pure indecision. Buyers pushed the price up, sellers pushed it down, and in the end, neither side won. A doji by itself doesn't mean much, but when it appears after a strong uptrend or downtrend, it often signals that momentum is slowing and a reversal could be near. Another important single candle pattern is the hammer. A hammer has a small body at the top and a long lower wick with little to no upper wick. This pattern usually appears at the bottom of a downtrend. Psychologically, what's happening is that sellers initially push the price much lower, but then buyers step in aggressively and push it back up near the opening price. This shows strong rejection of lower prices and suggests that selling pressure is weakening. The opposite of the hammer is the shooting star, which has a small body at the bottom and a long upper wick. It usually appears at the top of an uptrend and signals that buyers tried to push the price higher, but sellers took control and forced the price back down. Then we have the Marubozu, which is a very strong candle with almost no wicks. A bullish Marubozu means the price opened at the low and closed at the high, showing complete dominance by buyers. A bearish Marubozu means the price opened at the high and closed at the low, showing total control by sellers. These candles indicate strong momentum and often suggest continuation of the current trend, especially when supported by high volume. But single candle patterns are just the beginning. The real power comes from two candle patterns, which show a clear shift in control between buyers and sellers. One of the most popular is the bullish engulfing pattern. This happens when a small bearish candle is followed by a large bullish candle that completely engulfs the previous one. This shows that sellers were initially in control, but buyers suddenly entered with much stronger force, completely overpowering them. This pattern often appears at the bottom of a downtrend and signals a potential bullish reversal. The opposite is the bearish engulfing pattern, which appears at the top of an uptrend and signals a possible downward reversal. Another key two-candle pattern is the Harami. In a bullish Harami, a large bearish candle is followed by a small bullish candle that stays within the body of the previous one. This shows that selling pressure is losing strength and buyers are starting to step in. It's a more subtle signal compared to an engulfing pattern, but it still indicates a possible shift in momentum. The bearish Harami works the same way, but in the opposite direction, signaling potential weakness in an uptrend. What's important to remember is that these patterns do not work in isolation. A bullish engulfing pattern at a strong support level is much more powerful than the same pattern in the middle of nowhere. A hammer after a long downtrend carries more weight than a hammer in a sideways market. This is why professional traders always look for confluence, meaning multiple factors lining up together. When candlestick patterns align with support and resistance, trend direction, and indicators, the probability of a successful trade increases significantly. So at this stage, you should start seeing candlestick patterns not as magical signals, but as visual evidence of shifting power between buyers and sellers. Every pattern tells a story about who is gaining control and who is losing it. Once you train your eyes to recognize these stories, you stop reacting emotionally and start trading logically, based on what the market is actually showing you, not what you hope will happen.
Now let's get into the top 10 most reliable candlestick patterns that every trader, beginner or advanced, should know. These patterns are proven to work across all markets because they reflect fundamental human psychology: fear, greed, hesitation, and confidence, which never changes. Knowing these patterns gives you a huge edge because you're not guessing, you're reading what the market is actually doing. Hammer. We discussed this earlier, but it's worth emphasizing. A hammer appears after a downtrend, has a small body at the top, and a long lower wick. It shows strong rejection of lower prices. When confirmed with the next bullish candle, it can signal a reversal upward. Always check for volume spikes to confirm strength. Shooting star, the inverse of the hammer. This appears after an uptrend, has a small body at the bottom, and a long upper wick. It shows buyers tried to push the price up, but sellers overpowered them. Confirmation comes from the next bearish candle. Doji, a small or non-existent body showing indecision. Key types include gravestone doji, possible bearish reversal at the top, and dragonfly doji, possible bullish reversal at the bottom. Location matters. Appearing in the middle of a range is less meaningful than its support or resistance. Bullish engulfing, a small bearish candle followed by a large bullish candle that completely engulfs it. It signals a strong shift from sellers to buyers, often at the bottom of a downtrend. The opposite is bearish engulfing at the top of an uptrend. Morning star, a 3-candle bullish reversal pattern. Long bearish candle, small indecisive decisive candle, then a long bullish candle, appears after a downtrend and signals buyers regaining control. Its bearish counterpart is the evening star. 3 white soldiers, 3 consecutive long bullish candles with small wicks. It indicates strong buying momentum, and it's often seen at trend reversals or as trend continuation. The bearish version is 3 black crows. Piercing line, a 2-candle bullish reversal pattern. First, a strong bearish candle, then a bullish candle that closes above the midpoint of the first. It signals buyers stepping in after initial selling pressure. The opposite is the dark cloud cover for bearish reversals. Harami, a reversal pattern. A large candle followed by a smaller candle completely inside the first's body. A bullish Harami at the bottom suggests buyers gaining strength. A bearish Harami at the top signals sellers taking over. Marabuzu, a candle with no wicks. All action is in the body. A bullish Marabuzu indicates strong buying with full control, while a bearish Marabuzu shows strong selling dominance. It's a sign of trend continuation or breakout potential. Rising and falling 3 methods. Continuation patterns. For rising 3 methods, a strong bullish candle is followed by 3 small bearish candles inside its range, then a bullish candle closes higher. For falling 3 methods, the pattern is the opposite. These patterns show temporary pauses before trends continue. The key to using these patterns successfully is confirmation. Never act on a pattern alone. Wait for the next candle to confirm the move, or combine the pattern with support and resistance levels, trend lines, volume, or indicators like RSI or MACD. This reduces false signals and increases your winning probability. Candlestick patterns are more than shapes. They are a visual representation of market psychology. Every pattern tells you what traders are feeling, whether buyers are strong, sellers are losing control, or momentum is about to shift. Once you master these 10 patterns, you can read any chart, anticipate possible moves, and make trading decisions based on evidence, not emotions. With practice, recognizing these patterns will become instinctive. You'll start spotting setups even before they fully form, giving you a crucial edge in any market. Combine this skill with proper risk management, and candlestick trading can transform your approach from guesswork to strategy-driven decision-making. Now that you know the top candlestick patterns, the final step is learning how to use them effectively in real trading. Patterns alone won't make you profits unless you combine them with strategy, context, and risk management. Let's break it down step by step. 1. Confirm the trend in context. Always check where the pattern appears. A bullish engulfing candle at the bottom of a strong downtrend near a support level is far more reliable than the same candle in a sideways range. Look at support and resistance, trend lines, and moving averages. If multiple factors align with your candlestick pattern, the probability of success increases dramatically. 2. Use confirmation candles. Never act on a single pattern immediately. Wait for the next candle to confirm the pattern. For example, a hammer after a downtrend suggests a reversal, but confirmation comes when the next candle closes higher, showing buyers truly took control. This reduces false signals and prevents premature entries. 3. Combine with indicators. Candlestick patterns are visual psychology tools. Indicators like RSI, MACD, or volume help confirm the signals. For instance, a bullish engulfing candle with RSI showing oversold conditions is a much stronger buy signal. Volume spikes on reversal candles are also key. They show genuine market participation. 4. Entry strategy. For reversal patterns like hammer, morning star, or bullish engulfing, a common strategy is to enter just above the high of the pattern candle for a bullish trade, or just below the low of the pattern candle for a bearish trade. This way, you enter only if the market validates the pattern with further movement. 5. Stop loss placement. Risk management is crucial. Place your stop loss below the pattern's low for bullish trades and above the pattern's high for bearish trades. This protects you if the market moves against you, because patterns don't guarantee success. Your stop loss should always limit losses to an acceptable percentage of your capital. 6. Take profit strategy. You can target profits based on the next support or resistance level, previous swing highs or lows, or using risk to reward ratios like 1:2 or 1:3. For example, if your stop loss is $50 below your entry, aim for at least $100 profit. Patterns give you entry signals, levels and ratios guide your exits. 7. Avoid overtrading. Not every pattern leads to a profitable trade. Patience is key. Focus only on high probability setups where the candlestick pattern aligns with trend, support and resistance, volume, and indicators. Quality over quantity will save you from unnecessary losses. 8. Practice and keep a journal. The best way to master candlestick trading is practice. Start on demo accounts or paper trading and keep a journal of
each trade: pattern used, entry, stop loss, outcome, and lesson learned. Over time, you'll notice which patterns work best in which conditions and develop your own trading style. 8. Psychological edge. Candlestick patterns are effective because they reveal market psychology. As you practice, you'll start seeing fear, greed, hesitation, and confidence in real time. This gives you an edge over traders who only look at indicators or price numbers. They're reacting to the market while you are reading it. 10. Combine multiple patterns for better accuracy. Sometimes a single candle is enough, but combining patterns gives stronger signals. For example, spotting a bullish engulfing followed by a morning star near support dramatically increases the likelihood of a successful trade. Look for confluence, where patterns, levels, and indicators all tell the same story. In conclusion, candlestick patterns are one of the most powerful tools for traders because they provide a direct window into market psychology. Learning them is like learning a language. The market speaks to you in shapes and colors. When combined with context, confirmation, indicators, and strict risk management, candlestick trading transforms trading from guesswork to a strategic, probability-driven approach. Mastering candlestick patterns won't make you rich overnight, but it will give you a clear system, discipline, and confidence to trade any market successfully. With patience and practice, you'll be able to spot high-probability trades, manage risk effectively, and consistently improve your results.